What's up, guys? Welcome back to a new video. And in this video, I want to go over a mechanical trading setup that I recently took. That was a really great setup, one of the better ones I've seen in the last few weeks. And I want to discuss this one with you to show you the power of mechanical trading, but also to show you what kind of confluences I look at. So without further ado, let's get started. Right, so we are looking at the GBP AUD pair, and this is the daily time frame. And as you know, by watching this channel and watching my stuff, I trade mechanical. Mechanical means I trade black and white rules. There is no guesswork. It's either I enter or I don't enter, and I know exactly when to enter, where my target has to go, where my stop has to go, what the odds of winning are based on the past 10 years of data. What my maximum drawdown usually is. All these type of things I know because of mechanical trading, and it's really clear. I have a clear plan. There is no guesswork in it, which usually leads to problems, which I don't have. So without further ado, let's look at the setup. Now, my mechanical trading setup happened on this particular day, and it is comprised of a few different candles that you can see in this area. I'm not going to give you the rules. These are the rules for my clients, but I had a mechanical trading setup trigger at that area. Now, I always take my mechanical trades. Doesn't matter what the context is, but I do look at the context because I've noticed from my trading journal that if certain things align, that the odds of winning increase by around 10 to 15%. So I want to go over those confluence factors, but I do want to stress that if I get my mechanical setup like I did in this area, I always take it because the odds are in my favor. But if there are any confluence factors, I do add a bit more risk because these have a higher probability of success. So one of the first things you see is this big ass rejection candle just below this low. And if you think about it, this is the last low after the impulse up before that swing to the upside. So this is a really decent area for a fake out, just like we've seen here. And as soon as price broke that low, quick rejection there. So it shows me there is some buying interest at that level. Now, if we go to the hourly time frame, this area is what we're talking about. So here we had the rejection, which is also the selling climax in Wyckoff. For people that follow me, know that I trade the Wyckoff method. So you've got your selling climax. Then you've got your test at that area. And then we've got a clear spring in this area. So this is not a textbook example. And why is it not a textbook example? Because preferably you want to see a spring below that level and then quickly move up. However, this is definitely an important point of liquidity. You got some equal lows here, and this rejection is so very strong and so very violent, and especially because it's at that daily area. This is a clear accumulation range to me. And as soon as price closed below the high of the range, I entered a long trade. I believe I entered around that red level. And again, that's based on my mechanical rules. So the entry is based on my mechanical rules. This green line is also my target. That's based on my mechanical rules. My stop went below the spring, which is also fully mechanical, but the context is great. So you got that daily level, you got an accumulation range, clear absorption of liquidity below these lows, and then a violent breakout to the upside. So I went long. I'm going to put in the red line. I believe it was around this area. Target, upper green line, again, fully mechanical. But what's also interesting about this target is that if you look at the daily time frame, it's a clean level. So many touches in this area. You got 3 here, and another one here. So it's a clean level. And usually when my statistical targets or my mechanical target lines up with price action, the odds of success also increase. So to give you a bit of a recap, my statistics showed me, I'm going to show you my backtesting sheet. It showed me that there was a 62% chance of hitting the upper green line before taking out the lower green line if I entered along at this red line. And that's what I did. So only by doing that, only by following my mechanical setup, the odds are already in my favor. And if I keep trading this way over and over again without making mistakes, in the long run, I will make money. So that's the mechanical strategy. And the context is the location on the daily time frame, clean accumulation range, and the target lining up with clean price action on the daily time frame. Now, because I've been journaling for a few years right now, and I've been trading this setup over and over again, I know that if there's a clean accumulation range and if the target is in line with the with price action or any kind of structure, my win rate goes up with 10 to 15%. So the basis was 62% chance, but because of this confluence, we're looking at anywhere between 62 and 72, and 77% chance of hitting that green line before taking out the lower green line. So these are high odds. These are really high odds. And yes, the risk to reward ratio is 1-to-1, but I win way more often than I lose. And that's what it's about. You either win more with a basic risk to reward ratio, or you win maybe 30-40% of the time, but you risk 1 to make 2 or 3. It's all about a positive expectancy, and that allows you to make money in the long run. And then you have to think about, can I handle a lower win rate, or do I need a higher win rate? I prefer a higher win rate. My average risk to reward is usually 1-to-1 or 1-to-1.2, 1-to-1.3, anywhere in that region. But my win rate is anywhere between 60 to 80%. And that's when you really know your edge. And that's why having these statistics is so valuable. I tested some different confluence factors, etc., and it all shows me a clean edge in this area. So yeah, this has been tested back to 2012. So lots of data there. So yeah, this data is reliable. Sample size of 128 trades. And that just shows you that if you take the time to actually get to know your market instead of just trading it based on some random lines or some smart money concepts that someone claims to make money off, then you can really put the odds in your favor in the long run. And that's always what I stress with my channel. Know when the odds are in your favor and only trade when the odds are in your favor. And if you don't know when the odds are in your favor, start there, work on it, develop your edge, start to get to know your markets. Why is it behaving in a certain way? Is your strategy performing great in this markets? If not, what's the problem? Why is that the case? Can you test something mechanical to find if there's any edge? That's what you need to do. That's how you become profitable. That's how I became profitable. And this is a great example of a setup with edge. So great probability of success, clean absorption below these lows, great location on the daily time frame because of this rejection. And yeah, everything just lined up. So hopefully you find this video interesting. Please leave a comment and subscribe. And if you want more videos about me going over the charts and explaining stuff, also leave a comment down below, because I really enjoy these sessions. And if you want more of them, let me know and I will make a few more videos like this. So thanks for watching, and speak to you in the next video.